When you walk into a store and swipe your card for a $40 Calvin Klein t-shirt, you probably think you're just buying cotton.
Right. You find your size, you check the price tag, and you make a simple transaction.
Exactly, you just buy the shirt. But the reality is entirely different. When you buy that shirt, you are actually casting a vote in a multi-billion-dollar geopolitical war.
Oh, absolutely. I mean, it's a war involving the U.S. Supreme Court, the Chinese Ministry of Commerce, and this invisible army of 1,000 different factories.
It really is. Welcome to today's deep dive. I am your host, and with me, as always, is our resident financial expert. We are thrilled you're joining us today because we have a fascinating stack of source material to get through.
We really do, and it's incredibly fresh material, too.
Yes, literally as of yesterday, March 31st, 2026. We are looking at the just published Form 10-K and the earnings release for PVH Corp's 2025 fiscal year.
And for anyone who might not instantly recognize the corporate name, PVH is the global powerhouse behind Tommy Hilfiger and Calvin Klein.
Right. And what makes these particular SEC documents so compelling isn't just the financial data.
No, not at all. It's the survival story hidden within the numbers.
Yeah.
Honestly, it is a masterclass in risk management.
Exactly. The mission of this deep dive is to unpack how a massive, iconic apparel company manages to actually beat financial expectations while navigating what can only be described as, well, unprecedented geopolitical chaos.
It's a very tight needle to thread.
It is. We're going to look at the numbers, the strategies, and the global forces pushing against them. Okay, let's unpack this. Before we get into the massive global headwinds hitting PVH, I think you really need to understand the sheer scale of the machine itself.
That's a great place to start. You really can't appreciate the navigation until you understand the size of the ship.
So true.
And looking at their 2025 fiscal year, PVH generated $9.0 billion in revenue.
$9 billion.
Yeah, $9 billion. That is up 3% from the previous year, and they actually beat their fourth quarter guidance.
Which is huge. But what absolutely blows my mind is how concentrated that revenue is. Over 95% of that $9 billion comes from just two global brands, Calvin Klein and Tommy Hilfiger.
Just two brands carrying the whole load.
Right, because they used to own a portfolio of other heritage brands, things like Warner's and True and Co. But they sold those off a couple of years ago to aggressively focus on their core.
Yes, and that laser focus is the foundation of what they call the PVH Plus plan.
The PVH Plus plan, right?
Exactly. This is their multi-year, overarching strategic blueprint. The entire goal of this plan is to build Calvin and Tommy into the most desirable lifestyle brands in the world.
Which is no small feat.
Not at all. And they're executing this through a very specific playbook. They're creating what they call hero products and then amplifying them with intensely culturally relevant marketing.
Right, and they are not being subtle with the marketing dollars here. I mean, for Tommy Hilfiger, they've partnered with Travis Kelce, Formula One, and the Liverpool Football Club.
Massive global names.
Huge. And for Calvin Klein, they are working with massive global talent like Jungkook and Dakota Johnson. They are actively inserting these brands into the dead center of pop culture.
But, the PVH Plus plan isn't just about flashy campaigns.
Yeah.
It's also about tightening their grip on how the physical products are made and sold.
Which brings us to a massive strategic shift regarding their licensing agreements.
Exactly.
And this is a part of the strategy I find really interesting. For a long time, PVH licensed out the rights to make certain products like, say, women's apparel in North America to third-party companies. Specifically, Gthar Apparel Group.
Right, the licensing model.
Yeah. Essentially, Gthar made the clothes, slapped the Calvin or Tommy label on them, and paid PVH a royalty check. But PVH is now actively letting those licensing agreements expire so they can manage those products in-house.
They're pulling it all back.
Yeah, it feels like taking back the keys to your own car so you can finally drive it yourself.
That's a perfect way to look at it. When you license a brand, you surrender a degree of control over the daily execution.
Right.
By bringing it in-house, they control the steering wheel, the speed, and the final destination.
But hold on, here's where I want to push back a bit. Because I was reading through the 10-K and I noticed a glaring data point.
Oh.
Yeah. The document explicitly states that transitioning these licensed products in-house actually declined their gross margin by about 50 basis points in 2025.
Yes, it did.
And for everyone listening who doesn't read financial filings for fun, 50 basis points is exactly half of 1%. So taking the keys back is literally lowering their profit margin percentage.
It seems counterintuitive.
It really does. Why on earth would you willingly do that? Is having control really worth shrinking your margins?
Well, what's fascinating here is the strategic trade-off they are willingly making. To understand it, we have to look at the mechanical differences between licensing and wholesale.
Okay, walk me through it.
When PVH licenses a product to GSAS3, PVH has almost zero cost of goods sold for that specific item. They don't buy the fabric, they don't pay the factory.
They just sit back and collect the royalty.
Exactly, they just collect a pure royalty check. So the gross margin percentage on a licensing deal is incredibly high. It's almost pure profit on the top line.
Right, but when they bring it in-house, they suddenly have to foot the bill for all of that.
You nailed it. Suddenly PVH has to buy the raw cotton. They have to pay the manufacturing facility. They have to handle the ocean freight and manage the warehousing.
That's a whole different beast.
It is. You are operating a massive wholesale business now, which naturally carries lower initial gross margins than pure licensing royalties.
But I'm still stuck on the math here. They're projecting another 50 basis point hit in 2026. Taking a 1% total hit on a $9 billion pie over 2 years is tens of millions of dollars in lost margin. It just seems incredibly risky.
It is a calculated risk.
Yeah.
PVH is making a deliberate bet that absolute dollars matter more than percentages.
Interesting.
By controlling the product quality, the pricing strategy, and the consumer experience directly, they believe they will ultimately drive higher overall top-line revenue.
So they're playing the long game.
Precisely. They are essentially taking a calculated short-term hit to their margins today to buy a permanent moat around the brand's reputation tomorrow. They want total control of the consumer experience.
Okay, I see. So they are sacrificing a tiny slice of the margin percentage for total control and a much bigger overall revenue pie.
Exactly.
But of course, controlling your brand identity only works if you can actually afford to get those physical products across borders.
Right, the logistics of it all.
Which brings us to the geopolitical reality of 2026.
And this is where that simple T-shirt transaction we talked about earlier gets incredibly complicated. Let's look at the chaotic United States trade environment.
Yes, let's get into it. Now, looking at this U.S. tariff situation, I want to explicitly pause and address everyone listening.
Very important.
We are strictly reporting the financial realities found in the SEC filings here. We take absolutely no political sides regarding the Supreme Court's decision or the president's executive order. We are merely looking at how these policies impact the source material.
Exactly. We're just looking at the math, and that math is dizzying.
Walk us through the timeline.
Okay, early in 2025, incremental U.S. tariffs were implemented on goods imported from most countries. PVH noted that these 2025 tariffs cost them an 80 basis point hit to their gross margin for the year.
So, roughly a 0.8% hit right off the top.
Correct. But then, the legal landscape completely flipped. In February 2026, the U.S. Supreme Court ruled that many of those initial tariffs imposed by the federal government were actually unconstitutional.
Right. And immediately in response to that ruling, the U.S. president issued an executive order under Section 122 of the Trade Act of 1974.
That's right.
And this order imposed a blanket 15% tariff for 150 days, which became effective February 24, 2026.
And from a corporate planning perspective, a sudden 15% border tax is an absolute nightmare.
I can imagine.
Looking ahead to 2026, assuming that 15% tariff stays in place for the full 150 days, PVH is projecting a massive 215 basis point gross negative impact on their margins.
Wait, 215 basis points? That is 2.15%.
Yep.
On $9 billion in revenue, we're talking about roughly $190 million in sheer margin wiped out with the stroke of a pen.
It's staggering.
It's like trying to budget for a cross-country road trip while the price of gas changes every time you blink.
That's a perfect analogy.
It's less like managing a supply chain and more like managing a massive global hydraulic system. If the U.S. government suddenly pinches a valve on imports with a 15% tariff, PVH has to instantly increase the pressure in their Asian or Latin American pipelines just to keep the product flowing without bursting their profit margins.
That hydraulic system metaphor is spot on because it requires an unbelievable level of logistical agility to keep the pipes from bursting. You don't survive a 215 basis point tariff hit without a deeply ingrained mitigation strategy.
So how do they actually survive it?
Well, PVH explains exactly how they do it. First, they rely on an incredibly vast sourcing network. Their products are physically manufactured in approximately 1,000 independent factories spread across 30 different countries.
But how do they use that to their advantage? I mean, you can't just call a factory in a different country and say, hey, make 100,000 jackets by Tuesday instead of the guy in the other country.
I know it is highly complex. It involves shifting what are called tech packs.
Tech packs.
Yeah, these are the exact digital blueprints for a garment. So they shift these tech packs from a factory facing a high tariff to a factory in a country with a favorable free trade agreement.
Oh, wow.
It means physically repositioning raw materials, like bolts of fabric or zippers, across oceans. Because they have 1,000 factories, they have redundant capacity.
So if one goes down, another can pick up the slack.
Exactly. If tariffs spike for goods coming from one region, their sourcing teams immediately scramble to pivot production to another region to optimize tariff preferences.
So they are constantly adjusting the dials on this global machine.
They have to be. And alongside shifting production, they are aggressively driving internal cost efficiencies, finding operational savings inside their own walls to offset the border taxes, and heavily optimizing their discount strategies to protect the final retail price as much as possible.
They have to, or the consumer will just stop buying. But, the United States isn't the only superpower making life complicated for PVH's hydraulic system. Things are just as volatile, if not more so, in the East.
Yes, and this is perhaps one of the most critical risk disclosures in the entire 10K document. We really need to look at the situation in China.
And once again, I want to firmly remind everyone listening that we are impartially conveying this information exactly as it is stated in the 10K.
Absolutely.
We are not endorsing the viewpoints of PVH, nor are we endorsing the viewpoints of the Chinese government. We are simply unpacking the disclosed financial risks.
And the timeline here is crucial. In September 2024, China's Ministry of Commerce, known as MOFCOM, launched an official investigation into PVH. They were investigating suspicions that PVH had suspended normal transactions and adopted discriminatory measures against products or materials coming from China's Xinjiang region.
And this escalated incredibly fast. By January 2025, MOFCOM issued a preliminary finding that PVH had violated normal market trading principles.
Yes.
Then, in February 2025, they officially placed PVH Corp on the Unreliable Entities List, or the UEL.
This is a highly significant regulatory action. The UEL provisions give the Chinese government the broad authority to implement severe, crippling measures against companies on that list.
Now, the 10K says they don't know yet if or when MOFCOM will actually implement any specific measures or what they will be, but I want to ask you a pointed question.
Go for it.
If PVH ends up facing the absolute worst-case scenario, like being totally restricted from doing business in China, what actually happens to the company?
Well, if we connect this to the bigger picture, the financial and operational exposure is staggering. First, let's look at the financial math. The 10K notes that China represents roughly 6% of PVH's total global revenue.
Okay, 6% might sound manageable to some people.
Right, but here is the kicker. China represents a massive 20% of their EBIT.
And for you listening, EBIT is earnings before interest and taxes, basically the core operating profit of the business. So 20% of their actual profit comes from China.
Wow, exactly. It is an incredibly profitable market for them. If UEL measures are fully imposed, we are looking at heavy monetary fines, strict import and export bans, and severe restrictions on their ability to make investments in China.
It's essentially a total freeze.
It gets worse. Key personnel could have their visas denied or work permits revoked.
So, practically speaking, what does an import and export ban actually look like on the ground?
On the ground, it means chaos. It means raw materials sourced in China are frozen. Finished garments manufactured in Chinese factories that are meant for European or American stores get locked at the port and just can't be exported.
And what about their stores inside China?
Conversely, goods manufactured elsewhere can't be imported to stock the shelves of their retail stores in Beijing or Shanghai.
The supply chain just stops.
It halts completely. And financially, if they were forced to cease operations in China, PVH states they would face massive non-cash impairment charges.
Okay, let's pause there for a second. Non-cash impairment charges. What does that actually mean? They don't just lose physical cash out of a vault, right?
Correct. It's an accounting reality.
Yeah.
It means the assets they own in China, like long-term store leases, the brand value associated with that region, or physical store fixtures, are suddenly mathematically worthless because they can no longer generate revenue from them.
I see.
They have to write down the value of those assets on their balance sheet. On top of that, they'd face excess inventory write-offs for clothes they can't legally sell. They wouldn't be able to collect money owed to them by local partners, and they would have to scramble to completely shift any remaining manufacturing out of the region entirely.
It is a perfect storm of operational risk. Because of one UEL listing, 20% of their operating profit is held in the balance.
It's massive.
So, you have erratic, swinging U.S. tariffs projecting a 215 basis point hit. You have a major Chinese government investigation threatening a fifth of your profit. And we haven't even deeply touched on the other major logistical nightmare mentioned in the 10K, which is the massive Red Sea shipping disruptions.
Right. The Red Sea disruptions are severely affecting global shipping lanes. Commercial vessels are being forced to reroute entirely around the Cape of Good Hope in Africa just to avoid conflict zones.
Which fundamentally breaks the supply chain timeline. Instead of a standard transit, you're adding 10 to 14 extra days on the water.
Minimum.
Right. That means PVH's inventory is literally floating on the ocean longer, delaying their ability to sell it while simultaneously skyrocketing their ocean freight costs because the ships are burning way more fuel.
Exactly. So your shipping costs go up, your tariffs go up, and your international markets are threatened.
So what does this all mean? With erratic U.S. tariffs, a major Chinese investigation, and massive Red Sea disruptions, how on earth is PVH projecting stable profits for 2026?
It does seem impossible on paper.
Because they are. They're projecting their non-GAAP operating margins, meaning their margins adjusted for one-time irregular costs, to stay completely stable at around 8.8%. It honestly feels like magic math.
I get that. But this brings us to the final piece of the puzzle, and it's how companies survive this kind of chaos. It's aggressive internal restructuring and ruthless cost-cutting. PVH calls this their growth driver 5 actions.
Yes, I was digging into the financials on this. In 2025, PVH spent $93 million upfront on restructuring and severance. They have been actively simplifying their operating model.
Cutting the fat.
Exactly. And that $93 million upfront cost generated over $200 million in annualized savings. They achieved this by fiercely cutting their global office headcount by about 10%.
And that wasn't their only financial hit. In the first quarter of 2025, they also took a massive $480 million non-cash impairment charge.
There's that term again. But the 10K says this one was largely non-operational, driven primarily by a significant increase in discount rates due to the macroeconomic environment. Unpack that for us. How does the macro environment force a $500 million write-down?
Well, it comes down to interest rates and the time value of money.
Okay.
When global interest rates rise, which is what we've seen macroeconomically, the mathematical formula used by accountants to value future cash flows actually changes. A dollar you expect to make in 10 years from one of your heritage brands is suddenly worth less today because the discount rate applied to it is higher.
Oh, that makes sense.
So PVH had to mathematically write down the carrying value of their intangible assets on paper. Again, they didn't lose physical cash, but their balance sheet shrank significantly to reflect the new, harsher economic reality.
But the irony here is just fascinating to me, and I have to point it out. On one hand, you have PVH fiercely cutting middle management, shedding 10% of their global office headcount to save $200 million, right?
Right.
But at the exact same time, they're spending astronomical amounts on massive top-of-funnel marketing campaigns. They are paying A-list celebrities, Formula One teams, NFL superstars like Travis Kelce. It feels completely contradictory to be tightening the belt so severely in the corporate office while throwing millions at Hollywood and sports stars.
Well, this raises an important question about the modern reality of global retail. It isn't a contradiction at all. It is a vital survival mechanism.
Really? How so?
In a world where your supply chain costs are skyrocketing due to 15% tariffs, and shipping lanes around Africa are bleeding your freight budget, and major countries might restrict your operations, you have to find margins somewhere to survive.
So you trim the operational fat.
Exactly. To survive tariff hits and supply chain shocks, companies have to ruthlessly trim the middle management and administrative redundancies. You centralize your processes, you improve automation, you fire 10% of the office.
And then what?
And then you take every single dollar you save from those back office cuts and you redirect it directly into frontline consumer desirability and digital infrastructure. Because if a jacket now costs you significantly more to make and ship, the consumer has to want it desperately enough to pay the premium retail price.
And having Dakota Johnson or Jungkook wear it makes them want it.
Precisely. The brand heat has to be intense enough to cut through the economic noise. That is how PVH plans to maintain an 8.8% operating margin in 2026.
It's all about desirability.
Yeah, and it's why they feel confident enough in their cash flow to plan at least $300 million in stock buybacks this coming year, which is on top of the $560 million in stock they already bought back in 2025. They are betting that brand desirability will ultimately outpace supply chain friction.
It is an incredible high-wire act. We started this conversation talking about the simplicity of buying a t-shirt. But unpacking PVH's 2025 filings really proves that being well-informed about fashion requires a deep understanding of global trade, Supreme Court decisions, and macroeconomic strategy. Every single thread is connected to a geopolitical event. Thank you so much for joining us on this deep dive to explore how PVH Corp is balancing high fashion with high-stakes geopolitics.
It's been a great discussion, and before we go, I want to leave you with a final thought to mull over.
Please do.
We've talked extensively today about how PVH spent decades building a truly global supply chain, coordinating 1,000 factories across 30 countries, specifically to stay agile. But as we've seen with the stroke of a U.S. president's pen or a foreign ministry's inclusion on the unreliable entities list, this incredible global exposure is also their greatest vulnerability.
It's a double-edged sword.
It really is. It forces us to ask, is the era of the truly borderless global brand coming to an end? In the future, will massive fashion conglomerates be forced to physically and legally split their operations by hemisphere, creating one entirely separate supply chain for the East and one for the West, just to survive these deepening geopolitical divisions?
That is a fascinating and slightly terrifying question to consider next time you look at the Made In label on your clothing. Keep mulling that over and remember to stay curious. We will catch you on the next deep dive.